those Magnificent Seven stocks weren't so magnificent today. They were the Keystone Cops, I guess, just tripping over themselves. And I think that's one of the interesting things I've noticed, particularly in recent months, but really over the last year. The average international stock is outperforming the average U.S. stock. So if we look at the equal-weighted benchmarks, the equal-weighted EFI index, outperforming the equal-weighted S&P 500. And I think because it doesn't have those Magnificent Seven stocks in it, but also because they're more value-oriented, right? Lower valuations. But interestingly, in the third quarter, what do we get today? We got really strong U.S. economic data. Not true in Europe. Germany's probably in its fourth quarter of negative economic growth. But that's what central banks want to see. And so, we're seeing probably a clearer path to rate cuts overseas than in the U.S. I think that's favoring those equities.
All right, so wait a minute, though. So it feels more dire overseas, right, in terms of the economy?
Economically.
So, right, economically. So it makes sense that those stocks are under more pressure versus what we're seeing in the U.S., no?
Well, what I'm saying is they're outperforming on an equal-weighted basis in almost every sector, which is counterintuitive,
right,
looking at the economic and earnings picture. But they're undervalued, and I think looking forward to rate cuts next year.
Outperforming undervalued.
So essentially they're ahead of us when it comes to rate cuts from their own central banks. And perhaps that's why we're seeing, in your opinion, opportunity there?
Yeah, I think so. I think that's where I want to be focused for next year. And there are a couple different reasons. One, valuations. They're braced for a more difficult environment. I really do think we're going to see a turn down in the job environment. There's so many leading indicators of a softening in the labor market. I think we're starting to beginning to see that. And I don't think the U.S. markets are as well positioned for that than overseas.
We did just hear from Mark Bitzer, the CEO of Whirlpool, who said, we're not at the same place we were when it comes to employees over the last 2 years. I mean, raises aren't the same.
Right.
It's not as difficult to get them as they've been. But still, I mean, look at, Jeff, the data that we get each week when it comes to the jobs market, and then each month we're still adding more than 200,000 jobs a month in the U.S.
Yeah, it's interesting. I think there's a bit of a lag, and what we're seeing is, credit conditions tightening, banks are tightening lending standards. We're hearing more from CEOs that we moved out of a labor shortage environment to maybe a labor glut. Maybe that's overstated.
I haven't heard about a glut yet.
But they've talked more about just tracking the number of mentions of layoffs or headcount reductions or euphemisms for layoffs versus those for hiring in recent quarters has really started to pick up, and we're now seeing more layoff announcements than hiring discussions or talking about jobs being difficult to fill. I think that's the start of a turn here that we may see towards the end of the quarter.
I will say our Bloomberg economics team, I was just looking through my notes, the surge in continuing unemployment insurance claims indicates workers are finding it increasingly difficult to find new jobs. So if you start to parse through, as just the CEO of Whirlpool said, go below the headlines, you start to see some weak points. All right, so, okay. So I want to go back to international. So if they are outperforming, even though their economy is underperforming, are investors there already factoring good news or good news to come at some point? Because they're starting to kind of trade on what their expectations of kind of where things go. I'm trying to get an idea of as being a forward-looking market.
Yeah, that's a good way to put it. Rampant pessimism in Europe. We've got a war, recession, beginning to turn around, some signs of improvement. Some of it tied to China's economic growth, actually showing some signs of improving. I like to watch air pollution in China. That's been on the rise for a couple of months now.
That's depressing. But that's a good news for you.
No, it's good news. It's
I'm just going to throw that out there.
It's like a hedge fund, right? Like what the different metrics you watch,
But sort of the Magnificent Four in Europe are luxury goods stocks, and they benefit from a stronger Chinese consumer, so they're already starting to price in that turn as well.
But we've had a mixed bag with some of the luxury guys.
We have. I mean, I think it's early to count on that, but I think they're beginning to price in a better 2024.
So you're saying if you have new money to put to work, you would go to Europe?
I would.
You would go to Europe.
Yeah.
And so what's your exposure to the U.S.? How much have you scaled back? I'm assuming you would still suggest some position to the United States.
Look, people
ask
me
are you saying no?
What the right allocation is to international versus U.S., and I'm just saying more international than you have now. It's been 15 years. It's probably time to reconsider that and rebalance back into it. So I think almost any exposure is going to benefit a portfolio.
Okay.
That's interesting because, sorry, go ahead, Carol.
Well, but then I want to get an idea of what would you say in terms of the U.S. exposure?
I worry a little bit more about the very narrow U.S. market. So I think if you can get away from those, the 30% of the market, the Magnificent Seven, I think the market's looking better. But I would favor energy and financials in the U.S., which are where you can find the more attractive values and the stronger cash flow, which I think is going to be king in 2024.
All right, so you're not going to say 30% U.S.
I mean, I think it's
I know it's all individual, but I'm just trying to get an idea of how aggressive you are saying Europe versus or outside U.S. versus U.S.
I mean, I think you could look at it in the way you might look at the all country world index, right?
Yeah.
Which is like 60% U.S. and 40% international. I don't think that's a bad allocation.
Okay.
What would you
interesting.
say to someone who would push back on you and say, wait a second, if you look at the stocks in the S&P
I believe
500,
they say, wait a second.
wait a second. So many of the stocks in the S&P 500 have huge exposure internationally. I mean, especially those big,
Yeah.
big ones like Apple. The majority of its revenue comes from outside of the U.S., for example.
There are huge international companies that have a lot of U.S. revenue. So I think what it really comes down to is where is the investor base? For example, Nestle, I think, is the second largest stock in the EFI index. Compare that to Coca-Cola. They sell beverages and snacks to literally the same people around the world. Their revenue growth is almost exactly the same every year, but one trades 3 or 4 multiple points above the other. Coca-Cola. Why? Because 80% of Coke's investors are U.S.-based. About 80% of Nestle's investors are European-based. And again, recession, war, their pessimism is giving you a cheaper valuation. I think those converge.
It's an opportunity, you're saying.
Opportunity.
Okay.